Hello everyone, my name is Brian Jackson and welcome to the Power of 3 Trading YouTube channel. This is kind of the first video that I'll be posting where it's a voiceover of me kind of showing how I interpret price action in the futures market for the S&P 500 and Nasdaq. We'll also be looking at Dow Jones and how that correlates to the S&P 500 and Nasdaq, as well as the dollar index, or Dixie as traders call it. I'm really excited to do this video. It's something that I tried to do on Sunday, but my microphone wasn't working, so I had to tinker with that. But the concepts are still true. The video is still valid. It's a very high time frame chart that we're going to be looking at today. We're going to be looking at the daily chart for S&P 500 and Nasdaq. So there's a lot of things that go into play. But first I want to kind of introduce myself. Like I said, my name's Brian Jackson. I live in Eagle Mountain, Utah, and I've been trading for a little over a year, under a year. I started last year around this time. I was in a coding class to learn more about coding computer programming, and decided that's not what I wanted to do, decided that I wanted to learn more about the financial markets, and started diving in. I found what I liked and what I understood and how I like to view the markets, and everything that I'm going to show you here today, I learned for free on YouTube. If you want to learn more about how I understand price action in the charts for any asset class, that whether it be stocks, bonds, indices, crypto, any kind of commodity that you are interested in, these concepts work on anything in the stock market. It also works on any time frame that you look on. These concepts are very real, and they happen every single day. If you're interested in how I trade, feel free to go to the Inner Circle Trader YouTube channel, and I'll post a link below in the description section for his channel. These are his concepts. These are not my concepts. So anything that I refer to in the charts will be from ICT or the Inner Circle Trader. Like I said again, anything that I learned here is free on his YouTube channel, so feel free to check him out. First, I just want to kind of go over a little bit about how I understand price action from learning from ICT. What you're going to see here on the screen here is how I internalize the markets. This is something that you will see on every time frame. It happens every day. It happens every hour, every minute. This is a very consistent model, if you will. ICT calls this a model because it repeats itself in price. You'll be able to see it as we go throughout our overview today. But essentially, this is the ICT market maker model. You can apply this to a sell program, which in this case, this is a market maker sell model that you can see on the screen here. If we inverse this and we flip it upside down, you're going to get a market maker buy model, where this price leg right here is going to be higher than the initial price run here. So you'd have a price run lower and then a higher price run. That would make a market maker buy model. But we're going to be focusing on the market maker sell model today. And this right here, consistency is more important than frequency. This is how you stay in the game and be a career trader, is what I have been finding out and what I hold true to this day. Consistency is more profitable than frequency, meaning I cherry pick my setups. I cherry pick when I trade, the days that I trade, the hours that I trade, even the 15 minutes that I trade. It's very consistent. There's things that I'm looking for that are very consistent, and we're going to talk about those today in the market maker sell model. So a little bit of an overview of the market maker sell model. What we're going to have is you're going to see in price on a time frame that you're looking at, you're going to see a consolidation. Price is just kind of moving sideways. You're going to see some price fluctuation, but ultimately what we are looking for is a move outside of that consolidation, and you're going to see a price run happen, and then you're going to see another sort of shorter resistance in the form of a consolidation. The market will move sideways. You'll see another price leg move higher, a smaller price leg move higher, and then what you're going to see is a failure swing, meaning that see how this high right here, this is a major high, that's a major high, and that's a major high. This could have been a major high if the market was going to continue. It would have made a higher high up here somewhere, but it didn't. It failed to make a higher high. It made a low right here, and then ultimately right here, this low, market breaks that with a candle body, and you're going to see a retracement into this leg, and then a consolidation, price run, consolidation, move. This leg right here most of the time goes below the original consolidation that we saw here. So that's kind of an overview of how I trade, how I structure my trades in the market. Let's jump right into the charts. We'll come back to this model here, and I'll kind of show you how I internalize that in price action. We're going to start with the Nasdaq, and we'll move to the S&P 500, and we'll look at the dollar index as we go throughout, because that will help us structure how we internalize the market using this structure. So I'm just going to get rid of this real quick. Center. So this is the Nasdaq 100 micro E-mini futures. Futures contracts are not trading the actual spot price of a indice, whether it's the Nasdaq or S&P or Dow Jones. This is a futures contract, which means that the leverage is a little bit higher than what you would normally see from trading the stock price. If you want to learn more about futures, a quick YouTube search or a quick Google search will tell you how much each contract is worth and how much leverage is built into the price. But that's for another video. Right now, we're just worried about price action. So I have some levels that you can see here that are marked out. We're going to go over those. But ultimately, this is what we want to focus on first. Where did we come from? Where did price come from, and where is it going, and what is it going to do next? That's how we're going to structure this video. So as you can see, price filled this area right here. We saw a huge jump in price. Price came down and filled that right here, and then kind of bounced off of that area and moved into another area. I want to draw your attention to this candle right here, this green candle. If you want to learn more about ICT concepts, like I said, check out his YouTube channel. This is one of his teaching points. He calls them PD arrays, or premium discount arrays. And essentially what this candle is a algorithmic data point. Price is delivered by a highly complex algorithm. I'll be posting more videos about how the algorithm works, how you can learn more about the algorithm. It's not necessarily common knowledge that these markets are controlled, and ICT kind of exposes the controlled aspect of price action in any market. These markets are very highly controlled. They move within certain parameters throughout a day, and since they're controlled, that gives us data signatures of where price is going and what it's going to do next. So it's actually a good thing for us as traders to know that there are controls put into price action or price or these candlesticks that give us signatures of what the algorithm is going to do next. So I want to draw your attention back to this candle. This is a ICT bearish order block, meaning price, if it is going to continue lower, will bounce off of this candle. Usually we use the bodies, the low of the body right here. But as you can see, price bounced off of this black line right here, which is the very low of that candle. If I take I'll delete it real quick so that you can see it, and we'll zoom in. So from that candle's body, or the wick, the bottom of the wick right here, this is the body, and then the short little lines are the wicks. If I draw a line from that low straight across, you'll see that this high of that candle touches it and then moves away. That is a algorithmic signature that the algorithm puts out, that price is going to move in a certain direction. Now, as you can see, we have a high here and we have a low here. This is a range. This is a price range where price will want to trade in. This is the larger price range that we're going to be looking at, from this high down to this low. So you're saying, okay, price is moving lower. Where is it wanting to go to? Well, first off, we have to look at the dollar index. So I'm going to pull up the dollar index here. This is a different chart, and this just shows the dollar index. The dollar index is controlled by the Federal Reserve. If you think about it logically, the central bank, the commodity that it moves or that it handles is the US dollar. So this is their baby. This is what they want to protect. This is what they want to accumulate and distribute to make money. So they're going to control the dollar index for the betterment of the central bank. And we're going to kind of talk about institutional trading, institutional levels, interbank levels, central bank levels. They're all the same. But just know that the price of the dollar index is controlled by the central bank. And as we looked at in the Nasdaq, the dollar index is diametrically opposed to stocks or indices. As you can see, this is the dollar index, and then this is the Nasdaq 100 futures. You can see that as this moves lower, this is moving higher. So we want to see that correlation continue. And as we zoom out here with more data, you can see you get a high here, and then it kind of consolidates, moves lower, and then here's where you see the break. This is where it moves higher. This is where the dollar index moves lower, and they're diametrically opposed. That's what we like to see. That creates high probability trading conditions. When they start moving together, that's an indication that the central bank is manipulating price to accumulate orders or protect their positions and protect the dollar. So I want you to focus on this price range right here, from this candle's high to this candle's low. This is the price range that we're wanting to look at for the dollar index. And we'll zoom in here. There's a phenomenon that happens in the market, and ICT teaches this as well. It's the concept of a relative equal highs, and price will want to move above relative equal highs. And I want to draw your attention, now that you can see this right here. I'm going to delete it so that you can see what I mean by relative equal highs. You want to look for conditions where the markets look smooth, where the candle bodies or the candle wicks look too smooth. And you get this phenomenon of relative equal highs. See how this high right here, this high, and this high are all relative equal. They're all relatively equal, the same price. We're going to draw out a line just to show that. I'm going to use the very top one right here. I'm going to draw a line out. And I always use a blue line to indicate liquidity. And that's essentially what this is. From this level right here to this level right here, there's a pool of orders that are resting in this area that have not been taken yet. Um, this is a algorithmic area that price will want to move into to gather more orders to continue a move lower. A lower dollar index is good for inflation. That means that inflation is coming down, and that's what we like to see. That's what the Fed likes to see, because that means that the dollar is worth more. That means that they can accumulate more money, accumulate more wealth, and ultimately bring consumer prices lower, which we like. But in order to do that, what has to happen is the market essentially exhausts here. It runs out of movement lower. So what does it have to do? It has to soak up more orders to continue a price run. And so what we're looking at here is a consolidation. And what I would like to see in order for the dollar to continue its move lower is a move up into this area to soak up orders to continue a price run lower. Now I just want to show you that graphic again of the market maker sell model. Should have it right here. Now, if you were just to look at this, this looks kind of ugly. But if you frame the logic of a market maker sell model, you can see this very, very clearly. I'm just going to leave this right here. But essentially what you have is a small consolidation right here, a price run, a consolidation, a price run, consolidation. This is ultimately one price leg right here until you get this move right here. So here is your initial price run right here. This is your second price leg right here. And then this one right here is your small little price leg right here. And then what you get is a smart money reversal, as you can see here, SMR, and a higher time frame point of interest. This means that it has either swept liquidity, like we mentioned before, or it has hit one of ICT's higher time frame PD arrays, like an order block that we mentioned earlier in the video. What you have in this scenario is you have two relative equal highs. See this high and this high, how they're relatively an equal level. What you have is price moving above that to generate more orders to the downside. And you ultimately get this market maker sell model, where you have this smart money reversal, this failure swing, and then you have a price run, a consolidation, a price run, a consolidation, and then ultimately a price run. This price run did not go below this original consolidation. So in order to move lower, it has to soak up orders above where liquidity is pooled. That's what you're seeing here. And that's what we like to see. This is a very high probability area for the market to move up into so that it can move lower and create profitable situations for the dollar. and also to bring inflation down. The Fed is very concerned about inflation. They've done a pretty good job, in my opinion, of bringing inflation down. It's not a overnight thing, but from looking at the numbers and the reports, we're posed for market cuts in 2024, 2025, and 2026. So, in order to continue that trend, we need to soak up orders, move lower, which in return would mean that if we're going to move higher, that means that if the dollar index and stock indices are diametrically opposed, we're going to see a move lower in stock indices. Now, I have these levels marked out, and I'll show you why. So, if we bring that graphic back up, I'm just going to kind of put a little bit of lipstick on it here, make it a little translucent. Then I'm just going to kind of overlay this with the current market that we have right now. And what you're going to see is down here, you're going to see a small consolidation, a price run, a consolidation, which is here, that run to resistance, a larger price run here, which is this leg, and a smaller price run here, which is this top right here. So if I kind of go like that, you can see the very tip top. And then ultimately, what you have is a failure swing. This right here, that is your failure swing. This is what we call a low risk sell. ICT in his market maker series calls this a low risk sell. And essentially what this is large institutions and bank traders are protecting their positions above this high. This high is the highest the market has ever gone. If I zoom out here, this right here used to be the highest high that happened in 2021. We rallied all the way through 2023 to hit that. Now what we're seeing is a reversal to protect this position right here with bank traders. So we want to get in line with bank traders in the direction that they're trading, and this is a very high probability setup right here to go short in the market. And ultimately what we would like to see is a price leg move lower, a consolidation, a price move lower, and then ultimately this distribution come down below this low. And that is also what we're seeing in the dollar index. If I go back to this, we see here, boom, low risk sell, move here, consolidation, move here. It didn't quite get to here, move higher, soak up orders, move lower. So my outlook on the stock indices or Nasdaq is that we're going to see a sustained price run lower. This is going to happen for a while to soak up orders in order for the market to continue higher. The indices are a market that continually find higher highs. You're very rarely, unless there is a major event like we saw with the COVID-19, that the market, we call them a black swan event, where they create unfavorable conditions. The algorithm goes into kind of a safety mode or a circuit breaker mode where it protects its positions and protects it from a total collapse. So what I'm predicting in anticipating really is a sustained price move lower below this consolidation right here. This low, I would really like to see this low, this liquidity taken out within the next 2 weeks. And then we'll start to move lower and see that price run maybe move into March, April, something like that. What if I didn't mention it at the beginning of the video? This is not trading advice. I'm not a licensed I'm not licensed with the US government to give trade advice. So this is just my interpretation of the market using ICT concepts. Do not take this as trading advice. This is just how I internalize price movement in the marketplace for the stock indices and the dollar index. If you do take this as trading advice, do it at your own peril, because this is my disclaimer that this is not for anybody else but me and those who watch this channel for basically entertainment purposes, or to kind of learn more about ICT and introduce ICT concepts to those who don't know as much about them. Um, so that's Nasdaq. Um, I really like Nasdaq. I trade it almost daily. Move on to the S&P 500. You're going to see a very similar price structure. They're closely correlated markets, the Nasdaq and the S&P 500. You're going to see it's a very similar thing. You're going to see this same phenomenon starting to form, and we can anticipate that if price runs above here, it's going to be a continued price run higher, and this market maker sell model will no longer be valid. So it doesn't look like that's going to happen. We're already seeing price start to reject off of this order block. As you can see, price comes up into this order block right here and never gets above this high. It protects its positions for interbank traders and institutional traders, and this is what we call a low risk sell scenario. So if you were to short the market and target liquidity below that low, that low, this area that I have marked in here, which is a BISI, or a buy side imbalance, sell side inefficiency in the market, or this low right here, which below this is liquidity. Just a tidbit right here. Uh, Above every high that does not have a higher high on each side of it, this makes a swing point. So this means that there's liquidity resting above this high. Same thing with this. You have a candle that has a low that is not as low as this candle, and this candle is not as low as this candle, making this a swing low, meaning there's liquidity below this. You're not going to see liquidity really, major liquidity, in any of this price action. But you will see liquidity resting below this low, as that's the swing low point in this consolidation. So S&P 500, very similar to Nasdaq. Like I said, you're going to see very similar price movements. This is a typical market maker sell model. I mean, this is once you've looked at it, this is very obvious. The price is looking to move lower to begin 2024 in order to generate market orders to move higher. That's how I like to frame this idea. And you say, okay, what level specifically are you targeting? This is part of ICT concepts as well. If I take a Fibonacci tool, and typically this is a 62% level, this is a 70.5 level, and then this is a 79 level. I like to use the inverse of that. It helps my trading psychology a little bit more to use these, but these are just the inverse of those numbers. The 62% level, the 70.5 level, and the 79% levels. And we use these as retracement levels. Price has a very specific way that it likes to deliver. And we'll come back to this concept, but price moves from a premium to a discount. And what does that mean? That means that from this high to this low, this pink area is a premium level, meaning price is in a premium. This is very expensive price area. Below this in the green is a discount, meaning price is quote unquote in a discount area. It's cheap. This is the ebb and flow of the marketplace. What you're going to see is price move from a premium to a discount to a premium to a discount to a premium to a discount. As you can see, I have this marked out in fourths. So this is a very high discount. This is a very high premium. This is a smaller premium. This is a smaller discount. Now, very high probability trading areas is when you mix premium and discount with a Fibonacci retracement level that we just introduced. So these levels right here, if I take away this premium discount, just remember in the middle of this candle essentially is the difference between premium and discount. So we'll take away this. And basically right here is the cutoff point for premium and discount. So this level right here, 62% retracement level, 70.5 and 79% retracement level. This candle right here, this down close candle, is a higher time frame order block. Much like this candle is a bearish order block, this is a weekly bullish order block. You see how it almost exactly lines up with the 79% retracement level? This is a very high probability area for price to move into. Now, why would that be a high probability area? Well, you have these two relative equal lows right here on a daily time frame. Price will want to trade below that to gain market orders to move higher. You also have this area right here. We'll talk more about this in a different video, but this is a fair value gap or a BISI, buy side inefficiency. Sorry, BISI, buy side inefficiency, sell side inefficiency. So this is a imbalance in price, and there's going to be little cracks in this area. And there's a lot of things that we'll talk about in other videos, but just know that this is a high probability area for price to return to because it has liquidity resting below it, and this is a area of price where it has to fill gaps or fill holes in price action. And that fair value gap also lines up with this higher time frame order block. So you can kind of look at this market maker sell model and say, okay, where's a high probability target for me to aim? Where does the market want to draw to? And if it's going to go somewhere, where's a logical level for it to go to? This one right here, 0.79 or 0.21 in my case. You look at that level right there. We're going to zoom into it right here. You look at this level. Look at how it's the very tip top of that candle wick. Look at that. Boom. This candle's high comes in at 42.73.50. You can see that right here. I'm going to put my cursor on the candle right here. That high is 4273.5. Now, if we look at our Fibonacci retracement levels, and I'm going to put the prices on here. 4273.25. Now again, the high of that candle, if you look right here, as I hover over it, is 4273.5. This is 4273.25, off by 25 cents. Now, if you're going to squabble over 25 cents in a difference of precision, trading may not be what you're looking for. These markets are very precise. This is a level that I'm going to call in advance that the market will want to come back to, and it's going to do that because it's trading these algorithmic signatures. So we'll get rid of that. my first target is here, second target here, and then ultimately it's that 4273.5 level. Just in closing, if you feel inclined to leave a like, I would appreciate it. This is a lot of work to produce some of these videos. I know that this one is kind of running long, but I hope it gave you some insights into maybe some of the precision of ICT concepts and how price actually moves. It's not support and resistance or anything that you're going to find in any trading book. These concepts are specifically ICT concepts, and he teaches them for free on YouTube. Now, you might say that that's kind of sketchy. Why would anybody not charge for or try to make money from something that they are trying to produce? And he has had private mentorships, but to be honest, he's very sincere in his delivery of that these concepts. He felt like he was led on a spiritual journey by a Father in heaven, which I am a Christian. I am a member of the Church of Jesus Christ of Latter-day Saints. I am religious, and he talks about how this was a very spiritual journey for him and how he listened to a still small voice. Some of you may not like or have a taste for religion, but I feel very similar that when I trade, I feel like I am guided through these markets because I ask for help. And I will always give the glory to my Heavenly Father, who I pray to and who I love dearly. And if that's not your cup of tea, that's okay. Just know that these concepts, they're not necessarily spiritual concepts. They can work whether you're not spiritual or spiritual, but I feel like when I trade, if I ask for help, that I'm guided through these markets, and this is just my interpretation of price. Once again, this is not trading advice, and if you use these concepts without understanding of how they work within the market, you're going to be misled and not understand ultimately what you're doing. You have to spend lots of time diving into these concepts of trading. This is a daily time frame, so this is going to take a while to kind of play out. But ultimately, that's the draw on liquidity. That's where I see the market going to, is that level right here. And after that, we're going to need more information, or we'll be able to have more information based off of the price action here of what we're looking at next. But for now, that's the video. Thank you for spending time with me today and going over these markets. If you have any questions, please comment in the comment section, and I'd love to hear from you. Get any feedback of what you would like to see in next videos. I'm kind of thinking about going over a stock of someone's choosing. It doesn't really matter who's choosing, but whether it be Apple or Tesla or anything like that, for kind of a long-term analysis of where we're going with those markets. So uh, feel free to leave a like, and good luck and good trading, and I hope everything works out. We'll see you on the next video.